Hey Bowtie Nation, Joseph Hogue here, and the first in a new series here on the channel, our Just One Stock series. If you could only invest in one stock across different themes, which should it be? We'll be covering all the strategies here from value investing to growth, tech, index funds, and by the end of the series, you'll have a portfolio of the very best stocks to buy. Make sure you join the community by tapping that subscribe button so you don't miss any of these because it's going to be a complete portfolio of the best stocks. In this video, I'll show you what I'm looking for in value stocks, 4 simple factors to watch so you know you're investing in the very best. I'll show you how to use this in a portfolio, how to combine the very best stocks from different strategies into a high return portfolio. I'll then highlight 4 value stocks to watch, 4 that just nearly missed being the top pick, and then reveal that best value stock for your money. One I think has as much as 64% upside potential. First though, I want to personally invite you to get the weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Nation, it's been a tough year for investors, but that doesn't mean you can't make money. That idea that investors just always lose money in a stock crash is a myth. You see here the return on the S&P 500, that broad market index, along with the 11 sectors of the economy, and you see that the S&P has fallen nearly 12% over the last year. So yes, if you just invested in that index fund across the entire market here, you would have lost 12% of your money. But then you see the individual stocks on the right, and 150 of those stocks, almost 1 in 3 are up for the year, and 42 of those stocks are posting gains of 20% or more. In fact, the top 20 stocks in the index contributed more to its gains than the remaining 480 stocks combined. Nation, I invest in index funds, and I'm just fine getting the market returns on that part of my portfolio, but you need to know how to pick the best stocks to buy. Every investor needs a basic understanding of the factors that are going to find you those stocks that are going to outperform. Now, I want to get into our list of value stocks to watch, cheap stocks that nearly got that top spot, but stick around because I'm going to show you what to look for in these next. First up, the Mosaic Company, ticker MOS, down 43% from its high just 4 months ago, and a great play on the future of agriculture. And Mosaic is a leader in crop nutrients, phosphate, and potash, and it's ramping up its low-cost potash fields to really drive that profitability. Now, fertilizer is a commodity product, so the price just doesn't leave a whole lot of room for differentiation. So management has to be laser focused on those costs and efficiency. The world is expected to reach 8 billion people this year, though, and that means increasing food demand that's going to drive demand for fertilizers. Mosaic trades for just 6.4 times on a price-to-earnings basis versus an average of 8 times for stocks in the basic materials sector, and the company traded as high as 8.3 times just last year. The ROE and the operating margin, and I'm going to explain what these are and why they're so important when we're looking at value stocks in a minute, but both of these are around 25% for Mosaic. That's higher than the return on equity and the operating margin for rival Nutrien, which has an ROE of 19% and a margin of 21%, but it is quite a bit lower than the metrics for another rival, CF Industries. The trade-off is that shares of CF are priced so much higher on that PE basis, at 11 times earnings, that Mosaic is still a better value stock. There is a trade-off, though, when looking at these numbers, so stick around to hear the explanation on that later. The company's debt is just 39% of equity, and again, I'm going to go over that in a minute, but it's not high compared to Nutrien's 50% debt-to-equity ratio and 54% for CF Industries. Now, I actually think Mosaic could use a little bit more debt to leverage its returns higher without getting into trouble. Analysts have an average target price of $74 a share, up 65% from here, and even the low target is 26% higher. So a lot of confidence from that analyst community, and the shares pay a 1.3% dividend while you wait. We've still got 3 more stocks to watch and that #1 best value stock to buy, but I want to get your input on this as well. Watch through and let me know if you think any of these runner-up stocks should be the top pick or if you have a different value stock you like. Scroll down and let me know in the comments, what value stocks are you watching? Next on our list of value stocks, Tyson Foods, ticker TSN, the largest U.S. processor of chicken and beef, along with pork and protein-based snacks. I highlighted Tyson a few months ago in a video on companies with the best tools to fight inflation, and I really like this one on that trend in growing food demand. And Tyson has been able to grow its operating margin to 12% over the last 5 years from just 2% before 2017 and is really well run. Shares trade for just 7.5 times on a price to earnings basis, less than half the average multiple of 22 times earnings for the companies in the consumer staples sector, and a 4-year low for Tyson. The average price multiple has been 11.7 times over the past 5 years, so this stock is trading at a 36% discount. The operating margin of 12% and the ROE of 23% are both well above industry peers like Hormel and Conagra Brands, and the debt-to-equity ratio of 43% is very low for a food processor. And these companies have relatively stable cash flows as a staple product, so they can handle that higher debt loads and not run into cash flow problems. For example, Conagra has a debt-to-equity ratio over 100%. Now, there are just 4 analyst targets here, but the average is for $93 a share, about 12% upside, and a 19% upside to the highest target, along with that 2% plus dividend. We'll get right back to our list, but all you out there in the nation know, I'm not just about dropping a list of stocks in your lap and saying, go buy these. I want you to be a better investor, to be able to make your own investment decisions. So I want to show you what factors I looked for when picking these best value stocks. First though, why even care about value stocks? This graph shows the Vanguard Growth Fund, ticker VUG in red, has absolutely demolished the Vanguard Value Fund, ticker VTV in green, over the last 5 years. In fact, growth stocks beat the overall market, the S&P 500 in purple here, by more than 12% and more than doubled the return on that value stock fund over the period. But value stocks do have a history of beating growth. This chart goes back to 1983 with the areas in blue where value beat growth and those in orange where growth stocks dominated. And you can see that market dominance by either can last a very long time. After the tech bubble burst in 2000, it was value stocks all the way for 8 years, while growth stocks have led in the past decade. And it looks like that leadership has shifted again. Growth stocks started to break down in March of last year, and since the beginning of this year, it's been value all the way. That value stocks ETF is up over 32% over the last 2 years, 12% better than the market, and beating the growth stocks by more than 24%. But more importantly, and why I'm starting the series of best stocks with this one, is that if we continue to see market weakness, if stocks overall keep falling, then value stocks are going to fall less than the others. These stocks are already cheap on a valuation basis. They already have the fundamentals that make them a good investment. Now, that acts as a floor of support, so when the bottom drops out of the market, these value stocks have a parachute that slows the descent. I know you want to get back to that list, but I do want to show you what makes for a good value stock. First, you're looking for that classic value metric, the price to earnings ratio, the price of the shares divided by the company's earnings over the last year. Now, all you out there know, I like the price to sales ratio better here because it's just a little less easily manipulated by management, but I want to keep this screener simple, and I'm going to link to a video in the description detailing why you can't always trust the numbers you see companies reporting. Now, more important than just looking for a cheap stock with a low PE ratio of like 10 times or less, you want to find stocks with a PE ratio below the competitors in their industry. This is something we've talked about before, that you need to be comparing stocks against similar companies. For example, shares of Alcoa trade for a price of 11.4 times its earnings over the last year, looking relatively cheaper against shares of Meta Platforms at 12.4 times on that PE basis. Now, the problem though, and this is why I listed those stock sectors and the average PE ratio of the stocks in each sector, is what might be cheap in one sector is expensive in another. If you only ever invested in stocks with a PE ratio of 10 or less, then you'd end up with a portfolio almost entirely of basic materials, energy, and financial stocks because the PE ratios just tend to be lower in those 3 sectors. But comparing PE ratios against the companies in the same sector or against the sector average, it's going to help you find the true value stocks across the market. Look again though, and you see that Meta is actually the value stock among the two. Shares of Alcoa trade for 40% more than the average price to earnings in its sector, while shares of Meta are priced at a steep discount. Now, a low PE ratio alone doesn't make a stock a good investment. In fact, many low PE ratio stocks are cheap for a reason, and that's why we need to look at these other factors. You can find all these ratios free on Yahoo Finance under the Statistics tab for any stock. I like to double check the numbers, and I'm going to show you how to do that in a video linked in the description, but here I just want to give you that quick overview. If you scroll all the way down, you're going to find the total debt to equity ratio, probably the single most important measure for a value stock. Remember, most value stocks are cheap for a reason, and 99% of the time, it's because the company has an immense amount of debt that is limiting financial flexibility and could even force a bankruptcy. So this is the first place you want to check. The debt to equity ratio here is a percentage number. So this is 11.9%, and that's the long-term debt the company owes divided by the amount of stockholders' equity. Here again, you want to be comparing this against similar stocks because High debt in one sector might just be normal and totally workable in another, but generally the lower the better. These other two measures, the operating margin and return on equity, or ROE, they're great metrics for company profitability and management effectiveness. All you out there in the nation know the operating margin is probably my favorite metric, that core operational profitability of a company. It's how much in operating income management can squeeze out of every dollar in sales. The return on equity is the company's net earnings divided by shareholder equity, so that bottom line measure for what kind of return stockholders are getting on their investment. So when you're looking for those value stocks, start with that PE ratio to find those below the industry or the sector average. Then you use those other metrics to narrow your list. Which of those cheap stocks have a lower debt to equity ratio, and which ones are run better with higher operating margins and ROEs. Now that's how you find the cheap stocks that have real value under them. Next on our value stock list, American International Group, ticker AIG, one of the largest insurance and financial services firms, and sporting a 2.5% dividend. Now, AIG got destroyed in the financial crisis, but has built itself back up, and insurers typically do hold up really well in a recession. Besides those valuation measures we'll look at, I also like this one on a higher rate environment as well. You see, insurers need to invest all the premiums they collect, but have to invest in ultra-safe bonds and other investments because they can't take the risk. When they need the cash to pay claims, they can't wait for stocks to rebound. Now, rates on bonds and other yield investments have been absolutely dog shit for the last 5 years, but are now starting higher, which is going to mean higher profitability for these companies. AIG has a PE ratio of just 4.5 times, less than half the average for companies in the financial services sector. The operating margin of 23% and the ROE of 17.5% is also well above the industry average, and peers like Hartford Financial, which books 15% for both metrics. Now, the debt to equity is tricky for financial firms because of how they report their liabilities, really just deposits for banks or premiums for those insurance companies. But here, 51% isn't too high considering the cash flow stability. Analysts have an average target of $71 a share, almost 38% upside from here. And again, here's another deep value stock where even the lowest target is above the current share price. This next value stock, Freeport-McMoRan, ticker FCX, nearly made the top stock pick and is down 49% from this year's high on those falling prices in copper. Despite lower metals prices, Freeport is doing everything right, from increased production to higher operating margins and even decreasing debt. Now, copper and some of the other industrial metals the company mines are going to sell off in a recession, but we could be seeing serious shortages of copper and higher prices in the near future. Electric vehicles alone use more than 3 times the amount of copper compared to traditional cars. And copper is also a major component of renewable energy delivery, along with construction. After the sell-off, shares are trading in line with the sector average, around 8 times on a PE basis, but well under other peers like Newmont with its 47 times PE, and even Southern Copper, which I also like, but trading for an 11.6 times earnings. At 8 times earnings, FCX is trading at half its valuation of the last year. The operating margin of 39% and the ROE of 29% is below that of Southern Copper, with an ROE of 43% and a 55% margin, but way above Newmont and still a very well-run company. Freeport's debt to equity of 40% is just under the industry average and easily manageable. For example, Southern Copper has a debt to equity of 90% and still easily covers its interest expense. Analysts have an average target price of almost $45 a share, which would be 66% upside from here and 142% upside to that highest target. I'm revealing that top value stock next, the one value stock I think every investor should own, but I want to show you how to use this series of videos, how to create a portfolio of the best stocks to buy. And here, I'm going to be using the core satellite strategy, easily my favorite way to invest and something we've talked about before on the channel. The strategy is called the core satellite because you have a core of investments that make up between 50 and 60% of your portfolio. Now, these are in exchange-traded funds, ETFs. For example, you might have 15% of your money in the Vanguard Real Estate Fund, ticker VNQ, which holds shares of companies in the real estate sector. Maybe you hold another 10% of your money in the Vanguard Long-Term Bond ETF, ticker BLV, which invests in hundreds of bonds and pays a 3.3% dividend. Finally, maybe you hold 30 or 40% of your portfolio in a few funds like the ProShares S&P 500 Dividend Aristocrats ETF, ticker NOBL, a fund of the best dividend stocks in the market. So now by investing most of your money, that core 40 or 50% in these 3 to 5 funds, you're going to get instant diversification across stocks, bonds, and real estate. Your money is spread out across hundreds of stocks. You've got bonds in the bond fund and cash flow from the real estate fund. Then, with that satellite portion of your portfolio, the remaining 40% or so of your money, you invest in individual companies that you really think could produce those higher returns. The best value stocks, the best growth stocks, all the stocks I'm going to be showing you in this series. And the beauty of this core satellite strategy, though, is that because you only have maybe 40% of your money to invest in these individual stocks, and say you invest maybe 3 to 5% of it in each stock, that means you're only picking maybe 8 to 10 individual stocks. So instead of having to run around and find 20 or 30 stocks, doing hours of analysis on each and keeping up to date on each one, you only need a handful of winners, the very best stocks in each of these themes like value, tech, and dividends. And the best value stock, one I own in my own account as well as our Bowtie Nation portfolio, shares of Citigroup, ticker C, on its 5.5 times PE ratio and a dividend yield over 4%. Now, all you out there in the nation know I've been following the banks this year. The net interest margin, that's the difference between the rate banks pay on your savings accounts and the rate they collect when they lend out your money. That key profitability for banks just fell off a cliff over the last few years, but is now heading higher. In fact, Mike Mayo, managing director at Wells Fargo Securities, is estimating that the profitability from that net interest margin over the next 2 years for the banks could be the highest it's been since the 1980s. The Fed also just published its stress tests on the banks late June and found the industry capital requirements so strong that analysts expect the largest U.S. banks to return more than $80 billion to shareholders in dividends and share repurchases this year. The valuation on Citigroup is just 5.5 times on that price to earnings basis, and the stock goes for half of its book value. The average PE for financials is 11.3 times, and most banks trade for around their book value. For example, Bank of America trades for 1.07 times book, and JP Morgan is valued at 1.3 times book value. Citigroup is trading at a 37% discount to its 5-year average price to book value. Now, profitability is a little lower with just a 9% ROE and a 31% operating margin, slightly below the industry average. Bank of America has an 11.5% ROE and an operating margin of 35%, but the valuation is just too cheap on Citigroup, and the net interest margin is going to be that rising tide that lifts all boats. Analyst targets only put the shares about 26% higher over the next year to $59 each, but I think it's stronger than that, especially over the next 3 years. It's one of my favorite long-term stocks, along with the dividend, and I like it all the way back up to the peak of $74 a share, a 64% upside return. Click on the video to the right for a dividend stock portfolio that will pay you every week. 12 dividend stocks to put cash in your pocket every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.